Before we begin, a quick and important disclaimer. The following content is provided for educational and entertainment purposes only and does not constitute professional legal, financial, or tax advice. Divorce laws and retirement account regulations, including those governing 401k plans, vary significantly by state and are subject to change. This video explores general historical trends and case studies. However, every individual situation is unique. You should always conduct your own due diligence and consult with a qualified family law attorney, a certified financial planner, or a tax professional before making any decisions regarding your assets. Imagine waking up in a 4-bedroom colonial in a quiet cul-de-sac in Northern Virginia or the suburbs of Dallas. You have spent 25 years commuting, maximizing your employer match, and watching your retirement balance climb toward the 7-figure mark. You have done everything right. You skipped the luxury leases and focused on the long game. But then, a single envelope arrives on the granite kitchen island. It is a petition for dissolution of marriage. In that moment, your 401k is no longer just your retirement fund. It is a piece of community property on a chopping block. There is a silent epidemic sweeping through the American suburbs right now, often called gray divorce, where the single largest asset outside of the family home is being sliced in half by a legal mechanism most people cannot even name: the Qualified Domestic Relations Order. If you do not understand the math of the 401k split, you could lose 40% of your purchasing power before you even reach the age of 65. The problem we are solving today is the total lack of transparency regarding the intersection of family law and ERISA-governed retirement accounts. Most people assume that if their name is the only one on the account statement, the money belongs solely to them. In the eyes of most state courts, that assumption is a catastrophic financial mistake. Today we are performing a deep dive masterclass into how 401k assets are actually treated during a divorce, the hidden tax traps that can drain your remaining balance, and the specific steps required to protect the portion of your wealth that you built before you ever said I do. To understand the stakes, we have to look at the historical trends of wealth accumulation in the United States. For the average American suburban family, the 401k has replaced the pension as the primary vehicle for retirement. Unlike a house, which has emotional value and physical utility, the 401k is a mathematical engine. When that engine is stalled by a legal dispute, the compound interest stops working for you and starts working for the attorneys. We are seeing more cases where individuals in their 50s are forced to return to the workforce or delay retirement by a decade because they failed to account for the distinction between separate and marital property. Let's break down the first major pillar: the legal classification of the 401k. In many jurisdictions, especially community property states like California, Texas, or Arizona, any contribution made to a 401k during the years of the marriage is considered owned 50-50 by both spouses, regardless of who earned the paycheck. Even in equitable distribution states, the court looks at the duration of the marriage and the contributions of both parties to determine a fair split. This is where the complexity begins. Consider a case study of a software engineer in a Chicago suburb. He started his 401k in 1998, 5 years before he got married. By the time of his wedding in 2003, the account had $100,000. Fast forward to 2026, and the account has grown to $1.2 million through a combination of continued contributions, employer matching, and market growth. He might assume that because he started with $100,000, that entire amount is safe. However, without proper documentation and a forensic accounting of how that initial $100,000 grew versus how the marital contributions grew, a court might struggle to untangle the two. This is known as commingling. If you cannot prove the growth of the premarital portion, you risk seeing your entire 28-year career's work divided down the middle. This leads us to the second pillar: the Qualified Domestic Relations Order, or QDRO. This is the most important legal document you have likely never heard of. A standard divorce decree issued by a judge is often not enough to actually move money out of a 401k. Because these plans are governed by federal law, specifically the Employee Retirement Income Security Act, the plan administrator requires a very specific, separate court order to authorize the transfer of funds to an ex-spouse without triggering immediate penalties. The danger here lies in the execution. If a QDRO is drafted poorly, it can lead to unintended tax consequences. Normally, if you take money out of a 401k before age 59 and a half, you are hit with a 10% early withdrawal penalty plus ordinary income tax. In a divorce scenario, the IRS allows for a transfer to an ex-spouse's IRA or their own 401k without that 10% penalty, provided the QDRO is handled correctly. But here is the catch that catches many suburban families off guard. While the 10% penalty might be waived, the income tax is still due if the recipient decides to cash out the check, rather than rolling it over. We see this frequently in suburban high-conflict divorces. One spouse wants the cash immediately to buy a new home or pay off legal fees. They receive $200,000 from the other's 401k. They think they are getting $200,000. But because that money was never taxed when it was contributed, the IRS views that $200,000 as taxable income for the year it is withdrawn. If that recipient is in a high tax bracket, they might only see $130,000 after Uncle Sam takes his cut. Understanding the difference between pre-tax and post-tax assets is the difference between a successful transition and a financial collapse. Furthermore, we must discuss the role of the employer match and vesting schedules. In many corporate environments common in U.S. suburbs like those in the pharmaceutical or tech sectors, employer contributions do not belong to the employee immediately. They vest over 3 to 5 years. If a divorce occurs while a significant portion of the 401k is unvested, it creates a valuation nightmare. Do you value the account based on what is currently in it, or what will be in it 2 years from now? This is where professional valuation experts are often brought in to project the future value of those assets. Step by step, the process of a suburban 401k split typically follows a rigid path. First, there is the discovery phase. This is where both parties must produce every statement from the date of marriage to the present. For a 20-year marriage, this can mean hundreds of pages of documents. If you have changed jobs and rolled over old 401ks into new ones, the paper trail becomes a labyrinth. Each rollover represents a potential point of contention. If you rolled a premarital IRA into a marital 401k, you may have inadvertently turned a separate asset into a marital one. Second, there is the valuation of the marital portion. This often involves a formula known as the coverture fraction. This fraction is used to determine what percentage of the retirement benefit was earned during the marriage. The numerator is the number of months or years the individual participated in the plan while married, and the denominator is the total number of months or years of participation in the plan. This formula seems simple, but in the volatile markets of the 2020s, the timing of the valuation date is everything. If the market drops 15% between the day you file for divorce and the day the judge signs the papers, who bears that loss? In a suburban household where the 401k is the primary engine for future stability, a 15% swing on $1 million account is $150,000. That is the price of a college education or a significant portion of a down payment on a new home. We also have to address the psychological impact. In the American suburbs, the 401k is often tied to a sense of identity and security. It represents the hours spent away from family, the stress of corporate life, and the promise of a peaceful retirement. Seeing it divided feels like a personal theft to many. However, approaching this with emotion rather than logic is a recipe for disaster. We have observed that individuals who treat the 401k split as a cold, clinical business transaction tend to emerge with more of their wealth intact. They focus on things like the tax cost basis and alternative asset offsetting, where perhaps one spouse keeps the house while the other keeps the full 401k to avoid the complexities of a QDRO entirely. In this deep dive, we are going to explore why offsetting is often the preferred strategy for high-net-worth suburban couples, the specific language you must include in your settlement to avoid being audited, and how to protect your future contributions the moment the divorce is finalized. This is not just about losing money today. It is about protecting the compound interest of tomorrow. By the end of this masterclass, you will understand the mechanics of the 401k divorce better than most general practice attorneys, and you will be equipped to ask the right questions to ensure your financial survival. To navigate the complexities of a 401k split, we must first confront the reality of how these accounts are valued in a courtroom setting in 2026. Imagine a suburban couple, let us call them David and Sarah, living in a quiet neighborhood in Charlotte, North Carolina. David has worked for a major financial institution for 20 years, and his 401k is currently valued at $850,000. In his mind, he has done the heavy lifting. He survived the market volatility of the early 2020s, navigated the high inflation environment of 2024, and consistently increased his contributions as his salary grew. When the divorce proceedings began earlier this year, David assumed that the $850,000 would be his primary safety net. However, the legal reality of equitable distribution in North Carolina dictates that the court will look at the marital portion of that asset, which includes not just the contributions made during the marriage, but also the growth and interest accrued on those contributions. This brings us to the first critical granular detail of this masterclass: the date of valuation versus the date of distribution. In the American suburbs, where legal proceedings can often stretch over 12 to 18 months due to backlog, the gap between these two dates can be a financial chasm. If the court decides that the 401k should be valued on the date of the divorce filing, let us say January 15, 2026, but the market experiences a significant surge or a sudden downturn by the time the funds are actually transferred in November 2026, one spouse could end up with a windfall while the other is left with a deficit. Historical trends show that suburban couples often overlook the specific wording in their separation agreements regarding market fluctuations. If the agreement states that Sarah is to receive exactly $425,000 from the account, she is protected regardless of market performance. But if the agreement states she is to receive 50% of the account value, and the market drops 10% during the litigation, her absolute dollar amount shrinks. Conversely, if David is the one holding the account and the market rallies, he might be forced to give Sarah 50% of a much larger pie than he originally anticipated. This is why forensic accounting is not just for billionaires. In a 401k divorce, the ability to track every penny from the moment of the wedding to the final signature is the only way to ensure that the division is actually equitable. Let us look deeper into the concept of separate property credits. Imagine David had $150,000 in his 401k before he married Sarah. Under the law, that $150,000 is generally considered his separate property. However, in 2026, many courts are applying a more rigorous standard for proving that separate status. If David rolled that old 401k into a new employer's plan during the marriage, and then added marital funds to that same account, he has engaged in what is known as commingling. Without a clear paper trail showing the exact growth of that original $150,000 versus the growth of the new contributions, the court might rule that the entire account has been transmuted into marital property. This is a common trap in suburban divorce where long-term employees move between companies. Every time you roll over an account, you create a potential legal vulnerability. Case studies from recent years suggest that the most successful litigants are those who employ a strategy of tracing. Tracing requires a step-by-step analysis of the account's history. You have to account for every loan taken against the 401k, every withdrawal, and every change in investment allocation. For example, if David took a $50,000 loan from his 401k in 2022 to renovate the family kitchen, that loan was technically a marital debt that was paid back with marital funds. How does that affect the separate property credit? It complicates the math significantly. If you are not prepared with a detailed spreadsheet and a history of statements, you are essentially leaving your financial future to the discretion of a judge who may only spend 30 minutes reviewing your file. Another layer of this deep dive involves the specific rules of the plan administrator. Every 401k plan is managed by a third-party company, and each company has its own set of rules for how they process a qualified domestic relations order. Some plans allow for an immediate lump sum payout to the ex-spouse. Others require that the funds remain in the plan until the original account holder reaches retirement age or leaves the company. Imagine the frustration for Sarah if she was counting on that $425,000 to buy a new townhouse in a high-rated school district, only to find out that the plan administrator will not release the funds for another 15 years. This is why the drafting of the QDRO must happen concurrently with the divorce settlement, not as an afterthought. You must verify the plan's requirements before you sign the final decree. Furthermore, we need to discuss the impact of the employer match in the context of a 2026 workforce. Many suburban professionals work for companies with tiered vesting schedules. If David has $50,000 in unvested employer contributions, that money does not technically belong to him yet. However, it was earned through his labor during the marriage. Courts are increasingly treating these unvested assets as marital property, but applying a percentage based on when they will eventually vest. This creates a deferred distribution scenario. You are effectively staying financially tethered to your ex-spouse for years after the divorce is finalized, waiting for those shares or dollars to vest so they can be split. Now, consider the tax implications of the division method itself. There are two primary ways to split a 401k: the segregated account method and the percentage method. In the segregated account method, a new account is created within the same plan for the non-employee spouse. This allows the non-employee spouse to choose their own investments and manage their own risk. In the percentage method, the non-employee spouse simply receives a check or a rollover to their own IRA at a later date. Historical data suggests that the segregated account method provides more security for both parties, as it severs the investment risk between the two individuals. If David chooses to invest his remaining half in high-risk technology stocks while Sarah wants the safety of bonds, they can each go their separate ways without the other's choices affecting their bottom line. In the American suburbs, the house and the 401k are the two pillars of the middle-class dream. When one falls, the other often follows. We see many cases where one spouse agrees to waive their right to the 401k in exchange for keeping the family home. While this seems like a clean break, it is often a lopsided deal. A $400,000 house has maintenance costs, property taxes, and insurance. A $400,000 401k has potential for growth and eventually provides cash flow. Trading a liquid, growing asset for an illiquid, depreciating asset can be a path to what economists call being house poor. You have the suburban address, but you have no way to pay for your life once the paychecks stop. To avoid this, you must understand the concept of tax affecting. This is the process of adjusting the value of an asset to account for the taxes that will eventually be due. A $500,000 401k is not worth $500,000 in the same way that $500,000 in a savings account is. Because the 401k is pre-tax, you might only have $350,000 in actual purchasing power after federal and state taxes. If you trade $500,000 of home equity for $500,000 of 401k value, you have just lost 30% of your net worth in a single signature. As we move forward in this masterclass, we have to look at the specific documents you will need to gather and the exact questions you need to ask your HR department before you even tell your spouse you are filing. Most people wait until the lawyers are involved to start digging, but by then it might be too late to protect the paper trail. We have analyzed cases where crucial plan documents were updated or changed right as a divorce was starting, making it harder to prove historical values. But there is an even more dangerous trap waiting for you. What happens if the person who owns the 401k passes away before the QDRO is finalized? In many cases, the money goes to the named beneficiary on the account, which might still be the ex-spouse or, in some cases, a new partner, regardless of what the divorce decree says. The intersection of ERISA law and estate law is where many suburban families lose everything. In the next part, we are going to dive into the specific language of the QDRO itself. We will show you the 3 words that can save you $50,000 in taxes, and the one common mistake that can get your filing rejected by the plan administrator, forcing you to start the entire legal process over from scratch. If you think your divorce attorney is a 401k expert, you might be surprised to learn how many of them outsource this work because the math is so perilous. We are going to show you how to check their work and ensure your retirement remains yours. The danger of assuming your divorce attorney is also a QDRO expert cannot be overstated. In the high-stakes environment of the 2026 American legal system, specialization is everything. Many general practice family lawyers are excellent at negotiating child custody or alimony, but when it comes to the technical language required by ERISA, they often rely on standard templates that have not been updated for a decade. This is where the friction begins. A single missing sentence regarding the treatment of dividends or a failure to specify how investment gains are calculated between the date of the decree and the date of the transfer can lead to a rejection by the plan administrator. When a QDRO is rejected, the clock resets and the legal fees double. Let us look at a case study involving a project manager named Mark in a suburb of Seattle. Mark and his spouse decided on a 50-50 split of his $400,000 401k. His attorney drafted the QDRO using a flat dollar amount, $200,000 to be transferred to the ex-spouse. However, they failed to include language addressing what happens to the market growth on that $200,000 while the paperwork is being processed. It took the plan administrator 5 months to review and approve the order. During those 5 months, the market performed exceptionally well, and that specific portion of the account grew by an additional $18,000. Because the order specified a fixed dollar amount rather than a percentage plus gains and losses, Mark's ex-spouse missed out on that growth, and Mark was left with a tax-heavy surplus he had not planned for. Conversely, if the market had crashed, Mark would have been forced to sell more of his own shares to cover the fixed $200,000 obligation. This illustrates why the phrase including earnings and losses is perhaps the most critical addition to any transfer order. To navigate this, you must understand the 3 distinct types of QDRO language used by major U.S. plan administrators. The first is the shared interest approach. This treats the ex-spouse as a co-beneficiary, who will receive a portion of each benefit payment when the participant eventually retires. This is more common in traditional pension plans but is still seen in some older corporate 401k structures. The second, and more common for 2026 suburban professionals, is the separate interest approach. This essentially carves out a piece of the account and hands it over to the ex-spouse to manage as their own. The third is the lump sum distribution, which is often used when the balance is smaller, or when the plan allows for an immediate buyout. Imagine if you are sitting in a mediation session and the mediator suggests a simple split. You must immediately ask, is this order being drafted as a separate interest? If it is not, you could remain financially linked to your ex-spouse's employment status for the next 20 years. If Mark had used the separate interest approach, his ex-spouse would have had her own account established within weeks, allowing her to move those funds into a target date fund or a conservative bond portfolio suited to her own risk tolerance, completely independent of Mark's aggressive growth strategy. Historical trends in 2026 show that the IRS is becoming increasingly strict about the timing of these transfers. Under Section 72(2)(c) of the Internal Revenue Code, there is a very specific exception that allows for a distribution from a qualified plan to an alternate payee under a QDRO, without the 10% early withdrawal penalty. However, this exception is only available if the money comes directly from the 401k. If you roll the money into an IRA first and then try to take a distribution before age 59 and a half, you lose that exception and the 10% penalty applies. This is a massive trap for suburban families who need cash for a down payment on a post-divorce home. If you need liquidity, you must take it directly from the 401k during the QDRO process. If your attorney tells you to just roll it all into an IRA and figure it out later, they might be costing you tens of thousands of dollars in avoidable penalties. Let us explore another granular detail: the treatment of 401k loans during a divorce. In many suburban households, the 401k acts as a personal bank. You might have taken a loan to pay for a child's private school tuition, or to consolidate high-interest credit card debt. In 2026, many plans require that 401k loans be paid back in full if the employee leaves the company, or they are treated as a taxable distribution. During a divorce, the question arises, is the loan a marital debt? If David has a $30,000 outstanding loan on his 401k, the account statement might show a balance of $200,000, but the actual liquid value is $170,000 plus the obligation to pay back the $30,000. If the court splits the $200,000 nominal balance, David is effectively being forced to give away money he has already spent on the family. The step-by-step resolution for this involves a specific accounting maneuver. The loan must be added back into the total value of the marital estate, and then the responsibility for the remaining payments must be allocated. If the loan was used for a marital purpose, the ex-spouse should technically be responsible for half of the remaining interest and principal. However, since the loan is tied to David's payroll, this is practically difficult. A more common solution is to credit David for the outstanding loan balance before the split occurs. Without this adjustment, the spouse who holds the 401k is essentially being penalized twice, once by the debt and once by the division of the asset. Furthermore, we must address the issue of the survivor benefit. In the suburbs, where many families rely on a single high-earning spouse's retirement plan, the death of that spouse during or shortly after a divorce can be a catastrophic event. If the QDRO does not specifically name the ex-spouse as the surviving spouse for the purpose of the 401k benefits, and the participant dies before the transfer is complete, the funds may revert to the plan or go to a secondary beneficiary like a sibling or a new spouse. This is why a professional QDRO drafter will include a provision for a qualified pre-retirement survivor annuity. This ensures that if Mark passes away in a car accident, while the lawyers are still arguing over the house, his ex-spouse's share of the retirement account is legally protected. Historical case studies show that the most common reason for QDRO failure is a lack of communication with the plan administrator. Before you even draft the order, you or your professional consultant should request the plan's summary plan description and their specific QDRO procedures. Some plans, particularly those in the healthcare or education sectors, have highly idiosyncratic rules. For instance, some plans do not allow for the division of certain types of employer matching funds until the participant reaches a certain age, regardless of what the state court says. If your legal team is fighting for an asset that the plan literally cannot distribute, you are wasting thousands of dollars in legal fees on a ghost. As we move into the actual execution of the paperwork, there is a hidden danger in the way investment fees are handled. Every 401k has administrative costs, If the QDRO is silent on who pays the processing fee for the order, which can range from $500 to $2,500, the plan administrator will often deduct it directly from the participant's remaining balance. While $500 might seem small in the context of a $400,000 account, it is the principle of precision that prevents the slippery slope of financial erosion during a divorce. In the next part, we are going to look at the math of the 401k versus the pension. Many suburban employees, especially those in government, police, or firefighting roles, have both a 401k and a defined benefit pension. These are two completely different animals with two completely different sets of rules. We will break down how to value a pension that doesn't actually exist as cash yet, and why trading your 401k for your spouse's pension might be the smartest, or the most dangerous, move you ever make. We will also reveal the truth about Social Security offsets and how they can drastically change the percentage of the 401k you are entitled to keep. The transition from evaluating a defined contribution plan like a 401k to a defined benefit plan like a traditional pension is where many suburban divorce settlements hit a massive wall of technicality. Imagine a husband and wife, let us call them Brian and Jessica, living in a quiet suburb of Columbus, Ohio in 2026. Brian is a senior manager at a major logistics firm with a 401k valued at $500,000. Jessica is a dedicated public school teacher who has spent 20 years in the state retirement system. She does not have a massive 401k balance, but she has a guaranteed monthly pension waiting for her at age 60. In a standard mediation session, Brian might look at his $500,000 balance and feel like he is the one bringing all the wealth to the table. He might even offer to let Jessica keep her pension if he can keep his full 401k. This is a classic suburban trap. While the $500,000 in the 401k is a visible, tangible number on a screen, Jessica's pension has a present value that could easily exceed $800,000 or even $1 million depending on her years of service and final average salary. To compare these two, you cannot look at the monthly check. You have to look at the actuarial present value. This is the amount of cash you would need to have today, earning a specific interest rate, to pay out that monthly benefit for the rest of Jessica's life. If Brian gives up his 401k to save a pension he hasn't valued correctly, he could be walking away from hundreds of thousands of dollars in marital equity without even knowing it. In 2026, we are seeing a significant rise in the use of the Social Security offset in these exact scenarios. This is a concept that exists primarily in states like Ohio, Pennsylvania, and Massachusetts, where certain public employees do not contribute to Social Security because they have a government pension instead. If Jessica is a teacher and does not pay into Social Security, but Brian has been paying into it his entire career at the logistics firm, the court may view this as an unfair imbalance. Since Social Security benefits themselves cannot be divided in a divorce due to federal law, the court may calculate the hypothetical Social Security benefit Brian has earned and subtract that value from Jessica's pension before dividing the remaining assets. Historical trends show that failing to account for this offset can lead to a distribution that feels equitable on paper, but leaves the private sector spouse with significantly less total retirement income. Let us look at a case study involving a civil engineer named Kevin in a suburb of Phoenix, Arizona. Kevin has a 401k, but his spouse, Elena, has a vested pension from her years working for the county. They decide to use a method called the immediate offset to settle their accounts. In this scenario, they hire an actuary in early 2026 to determine the present value of Elena's future pension. The actuary determines the value is $300,000. Instead of drafting a QDRO to split the pension in the future, Kevin agrees to take $300,000 less from other marital assets, like the equity in their suburban home, to balance the scales. This is the cleanest way to divorce, but it requires liquid assets to be available elsewhere. If there isn't enough equity in the house or the 401k to cover that $300,000 offset, they are forced into the deferred distribution method. Deferred distribution is the legal equivalent of a long-term business partnership with your ex-spouse. You wait until the employee actually retires, and only then does the non-employee spouse receive their percentage. The danger here is the change in plan rules over time. Between 2026 and the time of retirement, the company could be sold, the pension plan could be frozen, or the laws governing state retirement could change. If you are the spouse waiting for that check, you are carrying all the risk of the employer's future stability. Furthermore, you have to ensure that the divorce decree includes language for a shared payment or a survivor annuity. If Kevin dies before he retires and Elena hasn't secured a survivor benefit in the court order, the pension might simply vanish, leaving her with zero. Now, let us pivot back to the 401k and the high-stakes world of the 2026 market. We must discuss the concept of the separate property component within a 401k that has experienced significant market volatility. Imagine if Brian had $100,000 in his 401k when he married Jessica in 2012. Over the last 14 years, that $100,000 has not just sat there. It has been reinvested, moved between funds, and impacted by market crashes and rallies. Many people assume they just get to keep the original $100,000 and split the rest. But what about the growth on that $100,000? In most U.S. jurisdictions, the passive appreciation on separate property remains separate property. If that original $100,000 grew to $250,000 purely through market movement, without any new contributions being added to that specific slice, then that entire $250,000 might be Brian's separate asset. However, the moment Brian used marital funds to buy more shares in that same mutual fund, he commingled the assets. To extract the separate portion in 2026, you often need a forensic accountant to perform a tracing analysis. They look at the unit or share price on the date of marriage and track those specific shares through every corporate action and dividend reinvestment. Without this level of detail, a suburban spouse might accidentally give away the gains from a decade of premarital smart investing. We also have to consider the impact of 401k contributions made during the period of separation. In the American suburbs, it is common for a couple to live apart for 6 months or a year before the divorce is final. If Brian continues to contribute $2,000 a month to his 401k while living in a separate apartment in 2026, is that money marital? The answer depends entirely on your state's definition of the cutoff date. In some states, the marital estate freezes the day you stop living together as a couple. In others, it continues until the day the judge signs the final paper. If you are in a state with a late cutoff date, every dollar you save while trying to move on with your life is actually 50 cents for your ex-spouse. Step by step, the math of the 401k split must also account for the hidden costs of the mutual funds within the plan. Not all 401k balances are created equal. If Brian's 401k is invested in high-fee actively managed funds, and he is trading it for Jessica's 401k, which is in low-cost index funds, he is losing more money to the internal expenses of the plan. Over a 20-year horizon, a 1% difference in fees can eat up 20% of your final balance. When you are deep in the weeds of a suburban divorce, you aren't just looking at the number at the bottom of the statement. You are looking at the quality of the underlying assets. As we continue this masterclass, we have to address a growing trend in 2026, the use of the 401k to pay for the divorce itself. While we've discussed how the 10% penalty can be waived for a spouse receiving funds via QDRO, there are very specific ways this must be handled to avoid a tax disaster. If you try to pull money out of your own 401k to pay your attorney, you are going to get hit with the penalty and the tax. But if the QDRO is structured to provide a cash distribution to the non-employee spouse, they can use those funds to pay their legal fees, effectively paying for the divorce with pre-tax dollars. This is a high-level maneuver that requires perfect coordination between your lawyer and your CPA. But what happens when the 401k isn't just a 401k? What if it includes company stock or specialized options? In many suburban hubs like Plano, Texas, or Irvine, California, employees are often compensated with restricted stock units, or NUA, net unrealized appreciation. If you treat company stock like a regular 401k during a divorce, you could be making $1 million mistake. In the next part, we are going to break down the NUA rule, the secret tax loophole that can turn a 401k split into a massive capital gains advantage or a massive tax trap. We will also look at the nightmare scenario. What happens when your ex-spouse refuses to sign the QDRO, and the plan administrator is threatening to lock the account? We will show you how to use a motion to compel and a signature guaranteed document to force the transfer before the market turns against you. The mechanism of the net unrealized appreciation, or NUA, is one of the most sophisticated tax strategies in the American retirement system, and in the context of a suburban divorce in 2026, it is often the difference between a thriving post-divorce life and a struggling one. Imagine a senior engineer named Michael living in the tech-heavy suburbs of Austin, Texas. Over his 25-year career, he has accumulated a significant amount of his employer's stock directly within his 401k. The total value of the stock is $600,000, but the cost basis, the price at which the stock was originally purchased years ago, is only $50,000. In a standard divorce settlement, Michael and his spouse might agree to split the 401k 50-50. However, if they treat this company stock like a regular mutual fund, they are ignoring a massive tax advantage. Under the NUA rule, if you distribute the company stock from the 401k into a taxable brokerage account as part of a total distribution, you only pay ordinary income tax on the $50,000 cost basis. The remaining $550,000 of growth is taxed at the much lower long-term capital gains rate when you eventually sell the shares. Historical trends show that suburban couples who fail to account for NUA during their QDRO negotiations often lose a significant percentage of their wealth to the IRS. If Michael's spouse receives half of the account through a standard rollover, she loses the ability to apply the NUA treatment to her portion. By the time she sells the stock to fund her new lifestyle in 2026, she could be paying a top-tier income tax rate of 37% instead of a 20% capital gains rate. When you are dealing with a $500,000 asset, that is a $93,500 mistake. Step by step, you must identify if the 401k contains highly appreciated company stock and ensure the QDRO language specifically preserves the right to utilize NUA for both parties. But what happens when the legal process breaks down? In the American suburbs, where emotions often run high and the financial stakes are tied to decades of labor, it is not uncommon for one spouse to engage in obstructionist tactics. Imagine if Michael's spouse, feeling that the settlement was unfair, simply refuses to sign the final QDRO paperwork or intentionally ignores the plan administrator's requests for identification. The plan administrator may respond by placing a hold on the account, preventing Michael from making any changes to his investment allocations while the market fluctuates. In 2026, we are seeing an increase in the use of the motion to compel and the use of leaser signatures. If your ex-spouse refuses to cooperate with the QDRO process after the judge has already signed the divorce decree, your attorney can file a motion to compel, asking the court to force the signature. If they still refuse, a judge can appoint an leaser, a court official authorized to sign legal documents on behalf of a non-compliant party. This is a high-level legal maneuver that ensures the 401k transfer is executed, even in the face of total hostility. You cannot allow a disgruntled ex-spouse to hold your retirement hostage, while the market risk sits entirely on your shoulders. Another critical pillar of the 2026 401k divorce is the management of the 401k loan default trap. We touched on loans earlier, but the technicality of the tax treatment deserves a deeper dive. Suppose Michael has an outstanding $40,000 loan that he used to pay for a suburban landscaping project or a roof replacement in 2025. If the divorce decree requires a 50-50 split of the gross balance, and Michael leaves his job or the plan administrator treats the loan as an offset during the split, that $40,000 is suddenly deemed a distribution. Michael is now responsible for the income tax on money he spent years ago. To mitigate this, a sophisticated settlement in 2026 will often include a requirement for the non-borrowing spouse to indemnify the participant for any tax liability arising from the loan, if they are receiving a portion of the account that includes that loan's value. Alternatively, the parties may agree to use other marital funds, such as a high-yield savings account or proceeds from a house sale, to pay off the 401k loan entirely before the QDRO is processed. This cleans up the balance sheet and prevents a surprise tax bill from arriving in the mail 18 months after the divorce is finalized. Let us look at a case study involving a healthcare executive named Sarah in a suburb of Nashville, Tennessee. Sarah's 401k includes a variety of assets: traditional pre-tax funds, Roth 401k contributions, and even some after-tax non-Roth contributions. Many suburban divorcees make the mistake of viewing the bottom line number as the only relevant metric. However, Sarah's $100,000 in a Roth 401k is significantly more valuable than $100,000 in her traditional 401k because the Roth funds will never be taxed again. If the divorce settlement simply says Sarah gives $200,000 to her ex-spouse, and the plan administrator pulls that $200,000 proportionately from all the sub-accounts, Sarah is giving away tax-free growth that she worked hard to secure. In 2026, a precise QDRO should specify the order of assets to be transferred. You might choose to give your ex-spouse the traditional pre-tax funds while you retain the Roth portion, effectively trading a higher present value for a lower long-term tax liability. This level of tactical asset allocation within a divorce is something most general practitioners simply do not discuss, but it is essential for protecting your net worth. We must also address the issue of the 401k valuation date in a volatile economy. Imagine the scenario where the court orders a split of the account based on its value on May 4, 2026. On that day, the S&P 500 is at an all-time high, but the QDRO isn't drafted, approved, and executed until September 2026. If the market has entered a correction phase during that time, and the account has lost 15% of its value, how is the shortfall handled? If the QDRO specifies a fixed dollar amount based on the May 4th value, the participant is forced to bear 100% of the market loss. If the account drops significantly enough, the participant might not even have enough money left in the account to satisfy the court's order after their own losses are accounted for. Historical case studies suggest that the most equitable way to handle this in the American suburbs is to use a percentage-based split that includes gains and losses from a specific valuation date until the date of distribution. This ensures that both spouses share the market risk and the market reward during the transition period. If you are the participant, you want your ex-spouse to share in any losses that occur while the lawyers are dragging their feet. If you are the recipient, you want to make sure you are capturing the growth of the economy while you wait for your funds to be released. Step by step, the implementation of these strategies requires a specialized team. You are not just hiring a lawyer, you are managing a financial transition. You need to verify that your plan administrator has received the draft QDRO for pre-approval. This is a critical step that many skip. By sending the draft to the HR or benefits department before it is signed by the judge, you can identify any technical errors or language conflicts while they are still easy to fix. In the next part, we are going to explore the intersection of the 401k and alimony. We will look at how the 401k can be used as a source for lump sum alimony payments to avoid years of monthly checks, and the specific IRS rules that allow this without a penalty. We will also dive into the nightmare of the multiple QDRO scenario. What happens when your ex-spouse is not the only person with a claim on your retirement because of a previous marriage? We will show you how the rule of first in time, first in right applies and how it can completely derail your current divorce settlement. The rule of first in time, first in right is a foundational principle of ERISA law that can feel like a financial landmine for suburban families navigating a second or third divorce in 2026. Imagine a high-level marketing executive named Robert living in a picturesque suburb of Atlanta. Robert is currently finalizing his divorce from his second wife, Amanda. They have lived a comfortable life, and his 401k has grown to a substantial $900,000. During mediation, Robert and Amanda agreed to a 50-50 split of the marital portion, which they calculate to be roughly $450,000 for Amanda. However, a massive complication arises from Robert's first marriage 10 years ago. When Robert divorced his first wife, he agreed to a QDRO that awarded her 30% of his total 401k balance at the time of his future retirement or distribution. Because that first QDRO was already approved by the plan administrator and filed with the court, it sits as a primary lien against the account. In the eyes of federal law, that 30% no longer belongs to Robert, it belongs to his first wife. If Robert tries to give Amanda 50% of the total $900,000, he is attempting to give away money that is already legally spoken for. Historical trends in complex family law cases show that if the current spouse's attorney fails to run a full search for prior liens, the participant can end up in a situation where they owe more money to ex-spouses than they actually have in the account. Step by step, the resolution of a multiple QDRO scenario requires a forensic look at the plan's priority list. You must obtain a benefit statement that specifically lists any alternate payees. If you are Amanda in this scenario, you need to know that your 50% is actually 50% of the remaining 70%. Without this clarity, you might sign a settlement agreement in 2026 that is legally impossible to execute, leading to years of renewed litigation and mounting legal fees. This is why transparency regarding prior domestic relations orders is a non-negotiable part of the discovery phase in any suburban divorce. Now let us transition into one of the most underutilized strategies in 2026, using the 401k as a vehicle for lump sum alimony. In many suburban households, the prospect of writing an alimony check every month for the next 10 years is a source of immense psychological and financial stress. Conversely, the spouse receiving the alimony often worries about the reliability of those payments. A potential outcome that solves both problems is to use a QDRO to transfer a larger portion of the 401k in lieu of ongoing monthly alimony. Imagine a case study involving a corporate attorney named Linda in a suburb of Philadelphia. Linda earns a high income, and her husband, who stayed home to raise their children, is entitled to significant alimony. Instead of paying him $5,000 a month for the next decade, Linda agrees to transfer an additional $400,000 from her 401k via a QDRO. For Linda, this is a massive win because she is paying her alimony with pre-tax dollars. If she had to pay him from her paycheck, she would have to earn roughly $8,000 to give him $5,000 after taxes. By using the 401k, she effectively gets a tax deduction on the alimony payment up front. For her husband, he receives a massive injection of capital that can continue to grow tax-deferred until he reaches retirement age. However, this strategy requires a very specific understanding of the IRS rules. If the recipient spouse needs that money today to pay for living expenses, they must be aware that while the 10% early withdrawal penalty is waived under a QDRO, the income tax is not. If Linda's husband takes that $400,000 and immediately withdraws it to buy a house in 2026, he could be hit with a tax bill of over $100,000, depending on his other income. This is why the alimony for 401k trade must be calculated on an after-tax basis. You are not trading dollar for dollar. You are trading future tax liability dollars for current tax dollars. This leads us to the critical concept of the 401k cash-out strategy for the non-employee spouse. In the American suburbs, the most immediate need during a divorce is often housing. With mortgage rates and home prices remaining high in 2026, many spouses find themselves unable to qualify for a new loan without a significant down payment. Under a QDRO, the spouse receiving the funds has a one-time window to take a cash distribution without the 10% penalty. Let us look at a scenario with a character named James in a suburb of Denver. James receives $250,000 from his ex-wife's 401k via QDRO. He decides to take $100,000 in cash to put toward a new home and rolls the remaining $150,000 into his own IRA. Because the $100,000 came directly from the 401k plan as part of the QDRO execution, he avoids the $10,000 penalty he would normally owe the IRS for an early withdrawal. This is one of the very few ways a person under age 59 and a half can access retirement funds for large purchases without a penalty. But here is the catch. James must ensure the plan administrator understands this is a direct distribution to him, not a rollover that he then withdraws. If the money touches his IRA first, the penalty-free window slams shut. Another deep dive topic is the treatment of the 401k during a gray divorce among couples over the age of 50. In 2026, this demographic represents the largest growth in divorce rates in the United States. For these couples, the 401k is not just a future promise. It is their current or imminent survival. If you are 62 years old and divorcing in the suburbs of Chicago, you might already be taking required minimum distributions or planning to do so soon. A QDRO for someone over age 59 and a half is fundamentally different because the 10% penalty is already off the table. The focus shifts entirely to tax bracket management. If the participant is in a 35% tax bracket and the recipient is in a 12% bracket, shifting a larger portion of the 401k to the lower-earning spouse can save the family tens of thousands of dollars in total taxes paid to the government. Instead of the money being taxed at the participant's high rate, it is distributed and taxed at the recipient's lower rate. Historical trends show that sophisticated suburban couples use the divorce as a moment to re-optimize their entire tax footprint, turning a painful legal split into a strategic financial move. Step by step, you must also account for the timing of the 401k contributions and the impact of the 2026 tax year limits. If you are mid-divorce and you continue to maximize your 401k contributions, you are essentially adding to the marital pot that your spouse is about to split. Some suburban professionals choose to stop their contributions during the litigation phase and instead put that money into a separate, post-separation savings account. This keeps those new funds out of the QDRO calculation, provided your state law recognizes the date of filing as the cutoff for marital property. But what happens when the 401k is held in a small business or a solo 401k? If you are a suburban entrepreneur or a consultant, your 401k might not be managed by a massive firm like Fidelity or Vanguard. It might be managed by you. In these cases, the QDRO process is even more dangerous because you are effectively the plan administrator who must approve the order against yourself. If you do this incorrectly, you risk disqualifying the entire plan, which could lead to the IRS treating every dollar in the account as taxable income in a single year. In the next part, we are going to look at the solo 401k and the small business retirement trap. We will show you why being your own boss makes a 401k divorce 10 times more complicated, and how the IRS looks for fraudulent transfers in these private plans. We will also dive into the world of hidden 401ks, how to use tax returns and payroll records to find the accounts your spouse might be trying to hide in a suburban game of financial hide-and-seek. We will reveal the specific line items on a W-2 that prove an account exists, even if your spouse claims they haven't contributed in years. The hunt for hidden retirement assets in a suburban divorce often begins not with a subpoena, but with a careful examination of tax documents from the 2025 and 2026 tax years. In many American households, one spouse handles the finances while the other remains focused on career or family logistics. This information gap creates an opportunity for asset concealment. Imagine a scenario involving a freelance consultant named Thomas in a suburb of San Diego. Thomas tells his spouse, Kimberly, that his business has been struggling and he hasn't been able to put any money aside for retirement. However, a deep dive into his Form 1040, and specifically his W-2 from a long-term contract gig, reveals a different story. You have to look at box 12 of the W-2. If you see code D, AA, or BB followed by a dollar amount, you are looking at proof of 401k contributions. Code D represents traditional elective deferrals to a 401k, while AA and BB represent Roth 401k and Roth 403b contributions. Thomas claims he has no retirement account, but his W-2 shows $22,500 under Code D. He is maintaining an active account that is a marital asset. Furthermore, the presence of these codes implies an employer-sponsored plan exists, which means there is likely an employer match that has been accumulating over the years. Historical trends in forensic accounting suggest that the paper trail for a 401k is almost impossible to fully erase because of the reporting requirements of the Internal Revenue Service. For the suburban entrepreneur with a solo 401k, the complexity increases tenfold. The solo 401k, or individual 401k, is designed for business owners with no employees other than a spouse. It allows for massive contribution limits, potentially up to $69,000 or more depending on the year and age-related catch-up provisions. In 2026, we are seeing many cases where a spouse attempts to hide income by overfunding a solo 401k right before filing for divorce. Since the business owner is also the plan administrator, they have the power to move money between investment accounts with very little oversight. Imagine Kimberly's situation if Thomas has a solo 401k. To find the money, she must request a copy of the plan adoption agreement and the last 3 years of Form 5500 Easy filings. Any solo 401k with more than $250,000 in assets must file this form with the Department of Labor. This is a public record that can expose the true value of a hidden retirement nest egg. If Thomas has been funneling business profits into this account to lower his reported personal income and keep assets away from Kimberly, the 5500 Easy is the smoking gun. Step by step, if you suspect a solo 401k exists, you must also look for transfers to brokerage accounts that carry the designation FBO, which stands for the benefit of. Often, a spouse will move 401k funds into a self-directed brokerage account to buy alternative assets like private equity or even physical gold. In the American suburbs, these alternative investments are a growing trend in 2026. If the 401k owns a piece of a local real estate syndicate or a private business, the valuation becomes a nightmare. You cannot just look at a daily ticker symbol. You need a formal appraisal of the underlying asset. This brings us to the small business retirement trap. If you are the spouse of a business owner, you might be entitled to a portion of a plan that is not liquid. If the 401k is tied up in illiquid assets, the plan might not have the cash to pay out a QDRO. In this case, the court might order an offset, requiring the business owner to pay out the spouse's share from other personal assets or by taking out a business loan. Historical case studies from 2026 show that these situations often lead to protracted legal battles over the discount for lack of marketability. The business owner will argue the asset is worth less because it cannot be easily sold, while the non-employee spouse will argue for full book value. Now let us look at the case of a character named Emily in a suburb of Boston. Emily is a physician who has multiple retirement accounts from previous hospital systems. She has 3 different 403b plans and 2 401ks. When she gets divorced, she assumes she only needs to split the one she is currently contributing to. This is a common misunderstanding of the discovery process. Every account that existed during the marriage, even if it was dormant, is subject to the coverture fraction we discussed in Part 3. If Emily has a 403b from a residency she completed 12 years ago, and that account has been sitting untouched and growing through market appreciation, That growth during the years of her marriage is a marital asset. In 2026, with the high performance of the tech and healthcare sectors, a dormant account from a decade ago could have tripled in value. If Emily's spouse does not specifically ask for the statements of every old rollover and dormant plan, Emily might keep hundreds of thousands of dollars in marital growth simply by omission. The process of finding these accounts involves a tool called a Social Security Administration Potential Private Retirement Benefit Information Notice. If you have earned a vested benefit in a retirement plan and then left that employer, the SSA often keeps a record of it. Requesting this record can reveal accounts that both spouses might have actually forgotten about. In the busy, transient life of a suburban professional who changes jobs every 4 years, it is surprisingly common for $20,000 or $30,000 to be left in an old 401k and forgotten. In a divorce, these forgotten sums are found money that can be used to offset other debts. Another critical pillar in 2026 is the role of loan recharacterization. We talked about 401k loans as a debt, but sometimes they are used as a weapon. Imagine if Thomas, seeing the divorce coming, took a maximum loan of $50,000 from his 401k and spent it on untraceable cash expenses or moved it to an offshore account. He then claims the 401k is worth $50,000 less. This is known as dissipation of marital assets. In a deep dive analysis, Kimberly's attorney would look at the timing of that loan. If it was taken within months of the filing for no clear family purpose, the court can add that $50,000 back to Thomas's side of the ledger. He doesn't get to reduce the marital pie by spending the money on himself. In 2026, suburban courts are increasingly savvy about digital trails. They will look at the bank transfers that happened the day the loan hit Thomas's checking account. If that money didn't go to the mortgage or the kids' tuition, it is coming out of Thomas's final share. We must also consider the tax impact of hidden accounts once they are found. If a hidden account is discovered late in the process, the cost of drafting an additional QDRO can eat up a significant portion of the find. This is why it is often more efficient to calculate the value and adjust the distribution of a more liquid asset, like the equity in a suburban home or a joint brokerage account. However, there is a risk here. If you take a larger share of the house to compensate for your spouse's hidden 401k, you are trading after-tax equity for pre-tax retirement funds. As we learned in earlier parts of this masterclass, that is not an equal trade. You must apply a tax adjustment factor. If Thomas's hidden 401k is worth $100,000, Kimberly shouldn't just take $50,000 of extra house equity. She should account for the fact that Thomas will eventually have to pay taxes on that $100,000, while her house equity is likely tax-free up to the $250,000 exclusion. As we move toward the final stages of the 401k split, we have to deal with the actual mechanics of the transfer. What happens if the plan administrator makes a mistake? What if they send the money to the wrong account or calculate the shares incorrectly? In the American suburbs, where 401k plans are often outsourced to massive call centers, these errors are more common than you think. In the next part, we are going to explore the audit and verification phase. We will show you how to read the final distribution statement from the plan administrator to ensure you weren't shortchanged by a clerical error. We will also dive into the world of post-divorce 401k management, how to rebuild your retirement nest egg in 2026 when you are starting over with half the balance and twice the expenses. We will look at the specific catch-up contribution rules that apply to divorcees and how to maximize your recovery in the shortest time possible. The moment the funds finally move from one account to another, many suburban residents breathe a sigh of relief, assuming the battle is over. In reality, the audit and verification phase is where the most silent and permanent financial errors occur. In 2026, the administrative systems of major financial institutions are processing thousands of QDROs daily. Mistakes in calculating the exact share price on the transfer date or failing to account for pending dividends can result in a shortfall of thousands of dollars. Imagine a character named Robert, a mid-level executive in a suburb of Indianapolis. After 18 months of litigation, his ex-spouse finally receives her share of his 401k. Robert assumes the plan administrator handled the math perfectly. However, because the transfer happened on a Monday following a high volatility Friday, the unit values used for the liquidation were slightly off. Without a manual verification of the number of shares moved versus the dollar value agreed upon in the decree, Robert could be overpaying by a margin that represents months of future contributions. Step by step, the audit process requires you to request a transaction detail report from the plan administrator. You are not looking for the final balance. You are looking for the share price at the exact moment of execution. You must compare this to the historical data for those specific mutual funds or ETFs on that day. If there is a discrepancy of even a fraction of a percentage, it can compound over time. Historical trends show that administrative errors in QDRO execution are more common in plans that utilize custom-engineered target date funds, as these funds do not always have a public ticker symbol that is easy to track. If your 401k is in a proprietary fund, you must ask the administrator for the internal valuation sheet used on the date of distribution. Once the verification is complete, the focus shifts to the psychological and financial mountain of rebuilding. Starting over at age 45 or 55 with half of a retirement nest egg is the reality for many in the American suburbs in 2026. The math of recovery is fundamentally different from the math of initial accumulation. You no longer have the luxury of a 40-year time horizon. This is where the IRS catch-up contribution rules become your most powerful tool. For those aged 50 and older, the IRS allows an additional $7,500 in 401k contributions beyond the standard $23,000 limit, based on 2024 to 2026 thresholds. Consider a case study involving a character named Susan, a nursing director in a suburb of St. Louis. After her divorce, her 401k balance dropped from $600,000 to $300,000. To recover her previous position, Susan has to aggressively utilize every tax-advantaged space available. This means not only hitting the $30,500 total 401k limit, but also maximizing her IRA catch-up of $1,000. By shifting her lifestyle, perhaps moving from a 5-bedroom suburban house to a high-end 2-bedroom condo, she can redirect her former mortgage premium into these catch-up vehicles. Historical trends suggest that individuals who maximize these limits immediately following a divorce can potentially recover 70% of their original purchasing power within a decade, thanks to the power of tax-deferred compounding on higher principal amounts. However, the 2026 landscape introduces a new variable: Secure Act 2.0 implications for high earners. If Susan earns more than $145,000 a year, the IRS may require her catch-up contributions to be made into a Roth 401k account rather than a traditional pre-tax account. This is a critical pivot in the American suburbs. While it means she doesn't get the immediate tax break today, it ensures that every dollar of that recovery growth will be tax-free in the future. For someone rebuilding after a divorce, this creates a diversified tax bucket that provides more flexibility during retirement. Imagine if Susan also uses a strategy called the backdoor Roth IRA. Since her income as a nursing director is above the limits for a direct Roth IRA contribution, she makes a non-deductible contribution to a traditional IRA and immediately converts it. In the context of post-divorce recovery, this allows her to put away an extra $8,000 a year in a tax-free environment. When you add the $30,500 in her 401k to the $8,000 in her Roth IRA, she is shielding nearly $40,000 a year from future taxes. Over 10 years, that is $400,000 of principal, which, with even conservative market growth, could bring her account back to its pre-divorce levels. Another pillar of rebuilding is the reallocation of risk. Many suburban professionals find that after a 401k split, their remaining portfolio is unintentionally lopsided. If the 401k was divided by taking a horizontal slice of every fund, your risk profile might remain the same. But if you traded assets, perhaps you kept the 401k while your spouse kept the house, your total net worth is now 100% tied to the stock market. This is a high-stakes gamble in 2026. Step by step, you must perform a total wealth stress test. If the market drops 20% tomorrow, do you still have enough liquid cash to survive without touching the 401k? If the answer is no, your first priority isn't the 401k. It is rebuilding an emergency fund in a high-yield savings account that covers 12 months of suburban living expenses. Let us look at a case study of a character named Mark, a suburban dad in New Jersey. Mark decided to keep his entire 401k by giving his ex-wife the equity in their family home. He felt like a winner because he kept the growing asset. However, he failed to account for the fact that he now has to pay rent in a high-cost area while also trying to contribute to his retirement. Without the stable, fixed-rate housing cost of his old mortgage, his ability to maximize his 401k was severely diminished. Historical trends in the U.S. suburbs show that the housing for retirement trade often fails if the remaining spouse cannot maintain a high savings rate. Mark's recovery plan required him to take on a side consultancy role just to bridge the gap. We must also discuss the role of life insurance as a 401k protection mechanism during and after the divorce. In many 2026 divorce decrees, the court requires the participant to maintain a life insurance policy with the ex-spouse as the beneficiary to secure the 401k transfer or alimony. If you are the participant, you need to ensure that the policy amount decreases as the 401k funds are successfully moved or as the alimony obligation expires. You do not want to be paying high premiums for a benefit that is no longer legally necessary. Furthermore, as you rebuild, you must update your beneficiary designations. This is the most common post-divorce mistake in the United States. Even if your divorce decree says your ex-spouse has no right to your retirement, the 401k plan administrator is legally bound by the name on the beneficiary form. If you pass away in 2027 and your ex-spouse is still listed on the 401k, the money will likely go to them, and your children or new partner will have to fight a losing battle in federal court. ERISA law almost always trumps state divorce law in this regard. As we approach the final stages of our masterclass, we have to look at the global picture of your 2026 lifestyle. Rebuilding your 401k is not just about the numbers. It is about the intersection of your career path and your retirement date. For many in the American suburbs, the divorce necessitates a career pivot or a delay in retirement. We will examine how to calculate your new retirement age with precision and how to use the Rule of 55, a specific IRS provision that allows you to access 401k funds early if you leave your job in or after the year you turn 55. But there is a dark side to the 401k recovery. What happens when the pressure to rebuild leads to risky investment choices? In the next part, we are going to dive into the danger of emotional investing post-divorce. We will look at the case studies of those who tried to catch up by betting on speculative assets and lost the other half of their retirement. We will also reveal the truth about 401k fees and how to slash them by 60% to accelerate your recovery without taking on more risk. We are going to show you how to turn your 401k into a lean, efficient machine that works twice as hard for you now that you are working for yourself. The danger of emotional investing after a suburban 401k split is a phenomenon that financial psychologists in 2026 often call the performance gap of the brokenhearted. When you see your retirement balance sliced in half, the primal instinct is to find a way to get it back as quickly as possible. This desperation often leads to a shift from sound, diversified strategies to high-risk speculative assets. Imagine a character named David, a suburban architect in Northern Virginia. After his 401k was reduced from $800,000 to $400,000 in a 2026 settlement, he felt a sense of panic. He felt he was behind on his life goals, and to compensate, he moved his remaining funds into a concentrated position in leveraged technology ETFs and in proven biotech startups. Historical trends show that individuals who engage in this type of revenge investing often suffer from what is known as the sequencing of returns risk. If the market experiences a downturn shortly after you have shifted to a high-risk profile, you lose the ability to recover because you have depleted the very principle you need for compounding. For David, a 10% drop in his new, aggressive portfolio meant he had to achieve an 11% gain just to get back to his post-divorce starting point. If he had stayed in a balanced, diversified allocation, his path back to $800,000 would have been slower but mathematically more consistent. Step by step, the first rule of post-divorce 401k management is to remove the emotion from the allocation. You are not trying to win back what you lost, you are trying to grow what you have. To turn your 401k into a lean, efficient machine in 2026, you must perform a forensic fee audit on your own plan. Most suburban professionals never look past the total balance, but buried in the fine print of the summary plan description are the expense ratios and administrative fees. If your 401k is packed with actively managed funds with expense ratios of 1.2%, and you add the plan's administrative fee of 0.4%, you are losing 1.6% of your wealth every year before you even factor in taxes. In a $400,000 account, that is $6,400 vanishing annually. Compare this to a lean portfolio of low-cost index funds with an expense ratio of 0.05%. Over a 15-year recovery period, the difference between these two fee structures can represent over $150,000 in final account value. In 2026, many major suburban employers have updated their plans to include brokerage windows, sometimes called a PCRA or Personal Choice Retirement Account. This feature allows you to move your 401k money out of the limited, high-fee options selected by your HR department and into the open market where you can buy virtually any ETF or stock. By utilizing the brokerage window, you can slash your internal fees by 60% or more, effectively accelerating your recovery without increasing your market risk by a single degree. Let us look at a case study involving a character named Maria, a pharmaceutical representative in the suburbs of New Jersey. Maria's post-divorce 401k was stuck in a high-fee target date fund that was underperforming the broader market. By opening the brokerage window within her plan, she shifted her assets into a total market index fund and a total bond market fund. This simple administrative move saved her $5,000 a year in fees. When you factor in the compound growth of that saved $5,000 over the next 12 years, Maria added nearly $90,000 to her retirement age projection without having to earn an extra penny or take on more volatility. Another critical pillar of the 2026 recovery is the strategic use of the Rule of 55. In the American suburbs, many people fear they are trapped in their jobs until age 65 because of the 10% early withdrawal penalty. However, if you are divorced and need to access your 401k funds to bridge a gap or pivot your career, the Rule of 55 is a lifesaver. Under IRS regulations, if you leave your job, whether through resignation, layoff, or retirement, in or after the year you turn 55, you can take penalty-free distributions from that specific 401k plan. Imagine a character named Kevin, a 56-year-old manager in a suburb of Chicago. His divorce left him with a 401k but no liquid cash. He wanted to transition into a lower-stress consulting role, but was afraid of the tax penalties of touching his retirement. By utilizing the Rule of 55, Kevin was able to take monthly distributions from his 401k to cover his suburban living expenses while he built his new business. He still paid income tax on the withdrawals, but he avoided the $10,000 in penalties he would have otherwise owed. This flexibility is a vital tool for the post-divorce pivot, but it only applies to the 401k of the employer you just left. If you roll that money into an IRA, you lose the Rule of 55 protection and must wait until 59 and a half. Furthermore, we must address the 2026 trend of the Roth conversion ladder as a recovery tool. For the high-earning suburbanite whose income has dropped following a divorce, you might find yourself in a lower tax bracket for a few years. This is a golden window of opportunity. You can convert portions of your traditional pre-tax 401k into a Roth 401k or Roth IRA. You pay the taxes now at your new lower rate, and the money then grows tax-free forever. Historical trends show that families who strategically convert assets during these low-income transition years significantly increase their after-tax wealth in retirement. Case studies of successful recoveries often point to the importance of the Health Savings Account or HSA as a shadow 401k. In 2026, if you live in a suburb and have a high-deductible health plan, you can contribute $4,150 as an individual or more with catch-up provisions. This money is triple tax-advantaged: tax-deductible going in, tax-free growth, and tax-free withdrawals for medical expenses. If you don't use it for medical expenses after age 65, it functions exactly like a traditional 401k. For someone rebuilding their retirement, maximizing the HSA is like having a second, smaller 401k that the IRS cannot touch. Step by step, your recovery plan in 2026 must also include a reassessment of your Social Security strategy. While we covered Social Security offsets in earlier parts, the timing of when you claim your benefits will now be dictated by your smaller 401k balance. If you were planning to claim at 62, the 401k split might force you to wait until 70 to maximize your monthly check. Every year you wait between 67 and 70 increases your benefit by 8%. For a suburban retiree with a halved 401k, that 24% permanent increase in Social Security income can be the difference between a comfortable lifestyle and a restricted one. As we move into the final phase of this deep dive, we have to talk about the ultimate endgame. What happens when the recovery is complete? How do you protect your new rebuilt 401k from future claims? In the American suburbs, where second and third marriages are common, the concept of the prenuptial and postnuptial agreement regarding retirement assets is the only way to ensure history does not repeat itself. We will examine how to ring-fence your 401k so that it remains your separate property even if you decide to say I do again in 2027 or beyond. But there is one final shocking detail that most people miss until it is too late. It is the issue of the 401k beneficiary and the federal preemption of the 2026 Secure Act. Even if you have a perfect divorce decree, a perfect QDRO, and a perfect recovery plan, your money can still go to the wrong person if you don't understand the nuance of the plan's legal documents versus your personal will. In the final part of this masterclass, we are going to wrap everything together. We will give you the 401k divorce survival checklist, the 10 questions you must ask your attorney, and the 5 documents you must never lose. We will show you the exact steps to take in the first 90 days after the QDRO is finalized to ensure your path to recovery is paved with ironclad legal and financial certainty. This is the moment you stop being a victim of the split and start being the architect of your new future. The transition from the legal battlefield back to financial autonomy is where most suburbanites fail, not because of a lack of effort, but because of a lack of administrative follow-through. In the final phase of this 2026 masterclass, we are focusing on the ironclad verification and the proactive defense of your newly established wealth. Imagine a character named Michael, a tech lead in the suburbs of Austin. He has his QDRO signed, the funds have been moved, and he feels he has finally reached the finish line. However, Michael forgets one vital detail: the federal preemption of the Employee Retirement Income Security Act. He has a new will that leaves everything to his children, but he hasn't updated the beneficiary form on his 401k portal. If Michael were to pass away unexpectedly, his ex-spouse would likely still receive the entire balance, because under federal law, the plan's beneficiary designation almost always overrides a state-level will or a divorce decree. This leads us to the first item on your 401k divorce survival checklist: the beneficiary purge. Step by step, you must log into every retirement portal you own, for 401ks, for 403bs, IRAs, and even old HSA accounts. You must remove the ex-spouse's name and replace it with your intended heirs or a trust. In 2026, many companies are automating these updates, but you cannot rely on the system. Historical trends show that litigation over beneficiary designations is one of the most expensive and heartbreaking sequels to a suburban divorce. You must print a physical or digital confirmation of these changes and store it with your final divorce decree. The second item on your checklist is the QDRO audit of the plan administrator's work. When the money was moved, did the administrator account for the exact unit value of the mutual funds on the valuation date? If the market moved 3% in the 5 days between the court's order and the actual transfer, that 3% should be accounted for based on the specific language of your order. If you were the recipient's spouse, and the order included earnings and losses, you must verify that you received those gains. If you were the participant's spouse, you must ensure you weren't double charged for administrative fees that the court ordered to be split. Case studies from 2026 suggest that clerical errors occur in approximately 8% of complex QDRO transfers. A simple phone call to the plan's compliance department to ask for a transaction detail statement is the only way to be certain. Next, we must address the strategy for your first 2026 tax return following the split. This is where the rubber meets the road regarding the 10% penalty exception we discussed in Part 1. If you took a cash distribution as the alternate payee, you will receive a Form 1099-R from the plan administrator. You must ensure that Box 7 of that form contains the correct distribution code. For a QDRO distribution, this is often Code 2 or Code G depending on the specific nature of the payout. If the code is incorrect, the IRS will flag your return for an automated penalty assessment. You or your tax professional must cross-reference this form with the specific 1040 instructions for retirement plan distributions. Consider a case study of a character named Jennifer in a suburb of Phoenix. She used $50,000 from her QDRO to pay off high-interest debt incurred during the litigation. Because her 1099-R was coded correctly, she saved $5,000 in penalties. If she had simply waited for the money to hit an IRA and then withdrew it, she would have lost that $5,000 instantly. This is why the timing of the cash out is a one-time surgical strike. Once that window closes, it does not reopen. The third pillar of your recovery is the reestablishment of your investment policy statement. In the American suburbs, we often fall into the trap of passive investing. But after a 401k divorce, your risk tolerance has fundamentally changed. You no longer have a dual income safety net. You are a single-engine aircraft now. Step by step, you need to reevaluate your asset allocation. If 50% of your net worth is now in a 401k, and you have no other liquid assets, your allocation should likely be more conservative than it was when you were married. Historical trends in 2026 show that divorcees who stay in aggressive growth portfolios often suffer more stress during market corrections because they lack the capital to wait for a 5-year recovery. We also need to discuss the ring fencing of your rebuilt assets. If you decide to enter the dating world and eventually remarry in the suburbs, you are entering a new zone of risk. In most U.S. jurisdictions, Assets you bring into a marriage are considered separate property, but the growth on those assets during the marriage can be claimed by a future spouse. To prevent a second 401k split, you must keep meticulous records of your account balance on the day of your second marriage. Better yet, you should consider a prenuptial agreement that specifically identifies your 401k as an excluded asset, including all future appreciation. In 2026, post-divorce prenups are becoming the standard operating procedure for the suburban middle class. Imagine if Michael, our Austin tech lead, remarries in 2027. He has rebuilt his 401k to $600,000. Without a prenup, if he divorces again in 2035 and the account has grown to $1.2 million, his new spouse could potentially claim half of that $600,000 gain. By ring-fencing the asset today, Michael ensures that his recovery efforts are protected for his own retirement and his children's inheritance. Now, let us look at the final, most important psychological shift: the transition from victim to architect. The 401k split is often viewed as a loss, but in the context of 2026, it is also a moment of total financial clarity. For the first time in years, you have complete control over your fees, your allocations, and your tax destiny. You are no longer compromising with a spouse who has a different risk tolerance or a different spending habit. Historical case studies of high recovery individuals show one common trait: they stop looking at the 50% they lost and start obsessing over the efficiency of the 50% they kept. They use the rule of 55, they maximize HSA catch-ups, and they utilize brokerage windows to slash their expense ratios. They turn their retirement plan into a high-performance vehicle. As you move forward from this masterclass, remember that the 401k is just one piece of the puzzle. Your suburban lifestyle in 2026 requires a holistic approach that includes your home equity, your Social Security timing, and your career longevity. But by mastering the QDRO, the NUA tax rules, and the recovery math, you have secured the foundation. You have taken a process that breaks most people and turned it into a masterclass in financial resilience. This concludes our 10-part deep dive into the 401k divorce in the American suburbs. You now possess the knowledge to navigate the discovery, the valuation, the legal drafting, and the long-term recovery with the precision of a professional. The envelope on the kitchen island was the start of a difficult chapter, but the steps you take today will determine how the rest of the book is written. You are now equipped to protect your past and build your future. While we have covered the retirement account in exhaustive detail, there is another silent predator in suburban divorces that can be even more destructive than the 401k split: the lifestyle creep debt and the hidden cost of the family home's mortgage recast. In our next series, we will explore the nightmare of the 2026 housing market divorce, how to handle 3% mortgage rates in a 7% world, and the secret to keeping your home without losing your mind.